Welcome to the Stock Health Series Explainer. In this video we will be explaining the importance of each and every point of our stock health videos. After watching this video you will be able to understand the score for all these points and also the relevance of the final score of our Stock Health Series videos. So sit back, relax, and let's get started. Business Model Score. In this category we are looking for the business model that company operates in. Example, if the company is manufacturing smartphones, then it's in a smartphone making industry or an electronic industry. So in this case we will be looking at what pace the smartphone industry has grown in past 5 years in India, and at what pace it is expected to grow in the next 5 years, so that we can understand at what pace our company can grow its revenues. In case of multiple model we will be looking at all the industries and determining what business model score should be given according to the data. Some industries might get an advantage while calculating this score, such as AI or technology or EV. And some might suffer, such as oil or paper industry, which might not do as well as previously mentioned industries. Score below 5 will be problematic for long-term investment. Liquidity score. In this score we would be looking at these three ratios. Debt to equity is long-term plus short-term borrowing divided by equity. This ratio should be as low as possible. Ratio is problematic if it's above 2. This can put a pressure on profits and can create liquidity problems, which can be further analyzed using next ratio interest coverage. Interest coverage is calculated as earnings before interest and taxes divided by the interest portion. This ratio should be high above 1, the higher the better. And the third one is current ratio. Current ratio is current asset divided by current liability, which are also called as short-term assets divided by short-term liability. This ratio should be above 1, it is considered best above 2. Final score for liquidity is out of 5. Company might face liquidity problems if the score is 2 or below, so better be above 3. Activity score. For activity score, let's look at the cash conversion cycle, which explains a lot about cash and product management simultaneously. In cash cycle, cash goes out to the supplier, who provides raw material to the company. Raw materials are processed to the final product, which sits on the company's inventory. The product is then passed on to the customer on credit or on an instant cash basis, which is then received back to the company. Now let's look at cash conversion cycle using formulas. Cash conversion cycle is days of sales plus days of inventory minus days of payables. Days of sales is time required by customers to pay. Days of inventory is time taken by products sitting on inventory. And days of payables is time taken by the company to pay to its suppliers. Days of sales is receivables by revenue multiplied by 365. Days of inventory is inventory divided by cost of goods sold multiplied by 365. And days of payables is payables by purchases multiplied by 365. Days of sales should be less than 60, the higher the worse. Days of inventory depends on what the inventory is. If inventory is perishable like milk or ice cream or other foodstuff, then DI should be quite less. For other types of inventory such as furniture or automobiles or defense equipment, higher inventory is quite okay but might hurt cash conversion. And days of purchases should be higher than 30 and less than 240, which gives flexibility to use cash in a better way. Overall cash conversion cycle is better from -60 to +180. A score below 5 out of 10 is considered not that great cash management. For profitability score, we will be looking at NPM, ROCE and ROE to see the efficiency of the company to generate profits out of current available capital and assets. Net profit margin is final profit divided by revenue. Better NPM ranges from 0 to 25%, higher the better. Too much high NPMs are generally not sustainable, hence are given equal importance to that of around 20% NPM. Next is ROCE, return on capital employed is calculated by profit before interest and taxes divided by total assets minus short-term liability. Best is above 20 but above 10 is also considered good. Single-digit ROCE can be problematic. And the last one is ROE, which is calculated as profit minus minority interest divided by equity. Equation same as that of ROCE, above 10 is considered good. The final score 3 and above out of 5 is better in case of profitability. In case of corporate governance score, promoter holding and pledge percentage are very important. There are two possibilities for promoter holding: either there is no promoter, which means the company is professionally managed, or there is a promoter with a certain stake. Higher stake, such as 70% plus, shows the promoter's high confidence in the company. This will attract higher scores. And pledge percent, on the other hand, should be as low as possible. 0 would be best. A score below 5 would indicate poor corporate governance. In statistics, a metric called standard deviation is used to figure out how stable or consistent the values are. Lower values of standard deviation symbolizes most stability. It can be run on various ratios, but in our case we have taken it on ROAS, NPM, asset turnover and inventory turnover. First 2 for profitable consistency and next 2 for operational consistency. Total score is out of 5 and figure below 3 is cautioned. In miscellaneous score, we will be looking for other pros and cons of the company which are probably not covered in any other points. These could be company or industry specific. A score lower than 6 is a sign of trouble. Next is growth score. Growth score is completely company specific, where we check past 7 years' performance of revenue growth. Below 4% growth is considered poor. Average growth is from 4 to 7%, and above and 7% is considered amazing. Depending on those factors, we have a final score. A score above 10 out of 15 is outstanding. Lower scoring stocks are not considered as growth stocks. And finally, valuation, which has the highest weight of score, that is out of 30. There are 3 important aspects that are checked to determine valuation score. First is price to sales. Undervalued stocks have price to sales lower than 5, which is calculated as market cap divided by revenue. In the second step, we find the proper value of the company. It is calculated by multiplying justified earnings and adjusted PE. This is the value company should be at. Then check if the actual value is lesser than the proper market value. If yes, then the company is undervalued, else overvalued. And finally, we would be estimating the future value. That is done by projecting revenue to the next 5-year mark, then using NPM to figure out earnings, and multiplying it to justified PE for proper valuation. After checking all the parameters, we will be providing the valuation score, which is out of 30. Below 10 and above 20 are the worst and best scenarios respectively. Then finally we reach a total health score, which is out of 100. There are 3 zones provided based on which you can figure out the stock health. Green being the best and red being the worst. Although this cannot guarantee any returns from market, but can help understand the difference between good and bad stocks. All the videos that we make are purely for educational purposes and cannot be taken as investment advice. Now you can watch our stock-specific videos, which will give you a clear idea of financials of stocks. Please do like and subscribe to our channel to keep us motivated for further videos.